This Greek restaurant IPO'd at $4 billion, reaching 297 locations just 17 years after being founded. And there's 7 business lessons that we can learn from the founder, Brett Schulman, if we want to succeed massively in this highly competitive restaurant industry. So let's dive right into it. First, let's discuss how Cava was founded differently than most other restaurants, because the way that Brett designed his first location enabled rapid scale from the beginning, everything from the menu to the team itself. Brett Schulman opened the first Cava location in just 2011. He was not actually a restaurant guy. He was a finance guy who partnered with food guys, meaning that there were a few key decisions that he made by taking that finance-first mentality to building a restaurant. To break them down, there were 3 things that were different about Cava's first location compared to most restaurants, which enabled them to grow so quickly and efficiently. And by the way, their expansion strategy, even beyond the first location, was a huge part of how they got to 200 plus locations. But more on that later. Anyway, the first thing to comment on is their menu strategy, because it was unique. Brett made Cava's menu strategically very small. Instead of having dozens of menu items like most new restaurants do, he chose to just focus on a few dishes and had as many shared ingredients across dishes as possible, which has a few key benefits. First, it reduced their food cost because his food waste was lowered with fewer ingredients, and it let him unlock bulk buying discounts from his food suppliers faster. Since so many of the ingredients were common across his dishes, he was using larger portions of them. This is so important because the average restaurant today is running at a 7% profit margin, meaning that for every dollar they sell in food, they keep just 7 cents in profits. But Brett's smaller menu, designed around food cost, meant that Cava has been running at over 20% profit margins from the very beginning, and these days it's closer to 26%. That means that they make over 3 times the amount of profit per order as the usual restaurant. Imagine each customer being worth more than 3 times as much to you as competitors. That's the competitive advantage that Brett got by thinking about margins from day one. And the way he's been able to achieve that is through being very strategic about the food costs of the menu items that he offers. He didn't start the usual way by adding the most popular Mediterranean dishes, kebabs and hummus bowls, and all of these other items that have a very high food cost, but are traditionally popular. Instead, what he did was he started with the popular Mediterranean dishes, which could be made even with the low food cost. And that led him to 2 categories of entrees that each have very high margins: the bowls on their menu and the pita dishes on their menu. Why? Because the main ingredients in their bowls, their most popular category, are greens like lettuce, which always have a low food cost, or grains like rice, which is about the cheapest ingredient we can find. The typical restaurant is running at 30% to 40% of every order going to food costs, while Cava gets by just spending 15% of their sales going to food costs. This is one of the reasons why they're so profitable. It's also increased their quality, interestingly enough, because it lets Brett master a smaller amount of recipes, instead focusing on getting the highest possible quality suppliers for each of the ingredients in their recipes. And that's the reason why so many of the most successful restaurant brands use this small menu strategy. From Cava to Chick-fil-A to Sweetgreen, it's this emerging trend among many of the most successful. And believe it or not, guests actually prefer and spend more money on smaller menus for a surprising reason. I used to think that it was better for marketing to have more items, since that gave customers more reasons to try a restaurant if they were looking for a specific dish that they love. But then I saw this study that totally changed my view on menu design, which showed that when given more options, people are way less likely to buy. The reason in psychology is called decision fatigue, meaning that if people are choosing between different menu item options, it's so mentally tiring for them to have to make a decision that in most cases they avoid making the decision in the first place and avoid buying. This is why the most efficient concept in the world of restaurants that we just talked about, Chick-fil-A, has just 7 menu items. It makes it as easy as possible to select an item, and they've spent years perfecting the recipes and the ingredients for those items that they're focusing on. So that brings us to the second major difference between Cava and others. from the start. They didn't just design their concept around reducing food costs, they designed it around reducing labor costs, and then reinvested those savings back into their team. Even in 2011, Brett was optimizing for low labor costs because labor is typically another 30% of a restaurant's cost equation. And of course, it's especially key now to control with the rising labor costs and how difficult it is to hire employees in our industry. The process is the same for preparing their bowls and pita sandwiches every time at Cava. They run down an assembly line of ingredients and then add in different ingredients depending on which type of bowl or sandwich the customer ordered. Like how you build an item at Chipotle or Sweetgreen. They get very efficient with their use of every employee. They don't need as many employees to operate their average $2 million location as others do. But here's where things get super interesting. They don't just pocket all of those savings in labor as profits, they use those savings as a competitive hiring advantage. Since each employee is more efficient for them, they can afford to pay them well above minimum wage and offer many employee benefits while still running those high margins. They've done that since the very beginning at their first location because attracting team members is so critical to success as a restaurant and as a business. You may have noticed that this is exactly what Chick-fil-A does and what Starbucks does, and it's for this exact same reason. The third major difference between Cava's concept and most other concepts is that they saw themselves as a technology company from the beginning. Even in 2011, they knew how important it was to have great technology and invested over $20,000 in their founding to build a top-notch website and mobile app for their brand. Over the years, they've spent an estimated $3 million on perfecting both experiences, their website and their brand mobile app, and have even created a mobile app team in-house. This would later be key to their expansion strategy because they used the location data from the branded mobile app that their customers downloaded to plan their expansion, but we'll give you more info on that later in this video. You may have noticed a pattern with many of the top performing restaurant brands, which is that they know how it isn't enough anymore to offer great food and great service. So much of the guest experience in restaurants is now happening online. People search for restaurants online and then read reviews online and compare different experiences online and judge a restaurant based on their website online. And now their ordering experience is online and their loyalty experience is online and much of their support experience is online. But not every restaurant has millions of dollars to invest in the right online technology like Cava does, which is actually why I built Owner.com. Owner.com today is known as the top-rated restaurant marketing platform in the world because it gives restaurants everything they need to succeed online. From a strong website that drives new customers to automated marketing to their own branded mobile app, similar to what Cava has, but for an affordable monthly fee rather than needing to invest millions of dollars in their online presence. If you're interested in getting more info on that, I recommend taking a look at Owner.com. You guessed it. Okay, so now that we've covered what was so different about Cava's concept to start, the question is now, how did they use these competitive advantages to grow so fast? And there's a few things that Brett uniquely did, starting by saying no to the franchise route. Many restaurant owners think that the path to a massive business is through franchising, meaning getting other people to put up their money to own new locations of the restaurant. And it's tempting for a few reasons. Brett easily could have done that with how efficient and popular his first location was. Yet, he didn't. Why not? Before we cover why, if you found this video helpful so far and you want to continue to learn about building a successful restaurant business, then click that subscribe button down below because I post a few new videos every month like this one where I break down what is working today to build and grow the most successful restaurants based on my experience now over the past 6 years. So, to get back to why Brett didn't go down the franchise route, it was because he wanted to maintain complete control of the guest experience, to continue to drive efficiency and positive word of mouth, which meant operating the restaurants himself. So how did Brett fund the growth to 297 locations in less than 18 years, if not from franchising? Brett followed a genius two-step process where he first focused on mastering that first location to prove out the concept and how efficient he could get it. He got it to running at more than 25% net profit margins, which is 3 times as profitable as the typical single location restaurant. Then he went to investors and he said, look at how profitable we can make each unit. We're making $400,000 in profit for this restaurant that cost us less than $1.6 million to open, meaning we get a 25% annual rate of return on our investment after we get paid back on the opening costs, and that is twice as efficient as the stock market. This is how those conversations go. It's based on the efficiency of returns relative to the stock market. And then, of course, he said, eventually we'll IPO and it'll be worth billions of dollars, which actually happened. Brett got investors to buy into this plan, and Kava raised its first $3 million round just 2 years after opening from private investors. Then the team went on to continue to execute, eventually engaging private equity firms with the same promise and raising over $738 million before going public. The best part is that those investors all did well because the company is now worth more than 5 times that amount in the public markets, and it's continuing to grow fast. It's a money printing machine. There was one other thing that Kava did well, which was key to its fast growth and success, and which I see the top performing independent restaurant owners consistently do when they want to expand. And that's following a takeover growth model, rather than defaulting to building out new locations from scratch each time. When Brett felt ready to expand, he didn't do it by using all of the investor money to build out new locations from scratch, like most restaurants do. Instead, what he did was he looked for restaurants that were less efficient than his and struggling. Then he offered to buy them and convert them to Kavas. This had a few key advantages. First, it saved him massively on location build-out costs, because if you think about it, rather than needing to spend millions of dollars building everything from scratch, he used people who already had done that, and he took over their assets with his more efficient asset. The biggest example of this was his acquisition of Zoe's Kitchen back in 2013. Zoe's Kitchen was another Mediterranean restaurant that had 200 locations at that point and were moderately popular and moderately efficient, but they weren't doing as well as Kava was. So what he did was he went to them and said, let us buy your business and we'll convert it into Kava. We'll pay you a combination of cash and equity. So buying them not only saved him in startup costs, but it had another key advantage, which was taking out his biggest national competitor and leveraging their millions of customers to grow faster himself. Because Zoe's Kitchen was a Mediterranean restaurant with a similar customer profile to Kava, and they'd been around for 20 years longer. They'd had millions and millions of customers at that point, as well as marketing systems like an email list and text message marketing to contact those customers. So when Kava bought them out, Brett not only converted the locations to save on build-out costs, but his new locations had built-in customer bases of millions of people who already loved healthy Mediterranean food and were a perfect fit for Kava's menu. That was the genius in it. But how did Brett and the Kava team decide where to put each new location? How did they decide which city and state to go to next? That's where their technology company from day one strategy really paid off. Meaning that from the beginning, the team at Kava had been pushing their customers to engage with them online by downloading their mobile app. When they started growing to multiple locations, they invested heavily in even creating an in-house IT team that was primarily responsible for upgrading their mobile app from scratch. And one of the key things that they built into their mobile app was location services. You might be wondering, Adam, what's location services? If you've ever downloaded an app, you know what it is, because it's that part where it asks you if the app can use locations. But where is it useful in growing a restaurant? Well, imagine being able to see the location information of all of the customers who have ever interacted with your business. That's where things get really powerful when you're planning to expand, because you can see the cities and the neighborhoods that your customers already tend to be in. Rather than having to start from scratch in becoming known in every city, you can strategically expand into the cities where your customers are already spending time and then serve them there too. But also filtered for another important factor, median household income. As he grew Kava, Brett noticed a very interesting pattern. New Kava locations did best in upper middle class urban neighborhoods. The typical area that Kava locations get opened in has a population of 115,000 people today, with an average income of $93,000. So what he did was he looked at the neighborhoods where his customer base was already active and then filtered it by checking the demographics of that neighborhood to match what he knew would lead to a successful reception of his locations. And then he would pull the trigger on cities only where he had lots of customers spending time there already and that were the type of upper middle class guest who loved his concept. Too often restaurant owners are forced to guess about where new locations will work and bet the entire company on it. But using this data-driven strategy is key. Side note, this is why my company at Owner.com have built the ultimate customer data platform for restaurants. Not only collecting the data from each customer, but helping them use that data like Kava did to increase sales and expand to new locations. Anyway, that's all for this video on how Brett Schulman built Kava into being a multi-billion-dollar success.